Welcome back to our channel again. I am Oya Benjamin and this is Sander. We provide you with videos that help you maximize profit and minimize loss. In today's video, we're going to be looking at the market structure, but we're going to be looking at it using the smart money concept. A lot of traders, especially the new ones, find it very difficult understanding the market structure using the smart money concept. I'll try as much as possible to simplify the smart money concept, everything about it, in a way that it will be very simple and very easy to understand, even to a newbie in the market. Stay tuned to the video. Don't go anywhere. If you are new to this channel, you are welcome. And to those that are already subscribed, thank you for your support and your trust. Now, before we go into the video properly, there are things that I will like us to look at, that will help us to understand the video properly. It will give us a proper understanding of the video. Now, first of all, I want us to look at the market structure. A proper understanding of how the market moves will give us a clue and a proper base to understand the smart money concept. Okay, I want you to understand that the market moves in two waves: impulsive wave, a correctional wave. Now continues back with impulsive wave, now the correctional wave. Okay, now impulsive goes in the direction of the trend, correctional is opposition or interjection from the current direction of the market. Once a market has made the impulsive wave and a correctional wave, now the circle is complete. Now the market goes on repeating that circle over and over. Okay, now as this circle continue, they produce the highs of the market and the lows of the market. Okay, now whenever the market is making higher high and higher lows, then that particular market is in an uptrend. And whenever the market is making a lower highs and lower low, that particular market is in a downtrend. Okay, now if you look at it here, you discover that the second high here is higher than this first high, and the third high is higher than the second high. Now if you look at it, the fourth high is higher than the third high. The same thing goes to the low. You discover that the second low is higher than the first low, and the third low is higher than the second low. And as long as the market continues to maintain this higher high and this higher low, then the trend is a bullish trend. It is in an uptrend. But coming to the bearish part of it, you discover that the second high is lower than the first high, and the third high is lower than the second high. The fourth high is lower than the third high. Now the same thing with the low. The second low is lower than the first one, and the third low is lower than the second low, and the fourth low is lower than the third low. Now as long as it continues in this sequence, the trend is said to be in a downward trend or a bearish trend. Okay, now but if there is any change in the pattern, okay, of this sequence, now a market shift has occurred. Now it gives us a signal that the market is about to shift to the direction, but that we will still see that in detail in this video. Let's look at how these movements are represented in the chart. Okay, you look at it here, you notice that this is the first high, and the second high is higher than the first high. The third high on this chart is higher than the second high, the fourth high higher than the third high, and so on and so forth. Now as long as the market keeps making this higher high and the higher low, this is the low, you look at this second low is higher than the first low, the third low higher than the second low, and so forth and so on and so forth. Now as long as the market keeps making this higher high and higher low, that trend is considered to be in an uptrend or a bullish trend. Now let's continue. Now there is something I want you to understand as a beginner. There is what is called a liquidity pool. Now let's look at this liquidity pool. First of all, I want you to know that the liquidity is the bloodline of the market. Now, when you talk about the liquidity pool, it simply talks about that point where it is very easy to sell your asset or your currency pair without any interruption. It's called the liquidity pool. The liquidity pool sometimes can be called the distribution phase. At this point, the buying momentum and the selling momentum are equal. This is what happens. Now, at this point here, now the market is moving up, and all of a sudden you see this, the market start coming down and moving again. Now here serves as the accumulation phase. Okay, now here is the accumulation phase. At this phase here, okay, accumulation phase, now this is the markup and this is the distribution phase. Okay, this is what the distribution phase. Now this is the markdown. Okay, now the accumulation again. Now at this point here, at this distribution point here, we have an equilibrium in the buying and the selling momentum. So you discover that there will be a lot of traders that will be waiting to enter the trade here. Now, because after the distribution point, now you will have a smooth movement before another accumulation. Okay, now so this point where a lot of traders tend to enter the market is called the liquidity pool. Okay, now if you look at this market here, now here this is a liquidity pool. Okay, this is a sell liquidity pool. Now once they enter here, they are expecting the market to go down without any obstruction. Now this one here is a buy liquidity pool. Now moving up, they meet another sell liquidity pool, buy liquidity pool. Okay, now these are points where a lot of traders, retail traders, enter their market. If you can target the liquidity pool right, that is where the huge profit lies in the market. Let's go to the next one as we look at the liquidity sweep or the break of structure. Once a trend breaks the previous liquidity pool, a break of structure has occurred. Now you can see, now this was the previous liquidity pool here. Now you notice that this impulsive move here, okay, broke this previous liquidity pool. At this point where this liquidity pool was broken, that is what we call the liquidity sweep or the break of structure, BOS. Now, another thing I want you to understand now before we move over is that the impulsive wave is the one that sweeps off the previous liquidity. And once the impulsive wave sweeps off the previous liquidity, now the next thing that you should be expecting is a correctional wave. And the sequence continues and so on until there is a change in the market pattern before a reversal pattern will occur. Now we look at the next one, which is the market structure shift or the market change of character. Now I want you to understand that once there is a shift in the pattern at which the current market has been running before, now a market shift or change of character has occurred. Okay? Now you notice that this has been the pattern. The market has been in a downtrend, making lower low, lower highs. Now all of a sudden, a change in the character. Okay, now look at this. This lower low was maintained here. Now we should be expecting that the next high that is to form should be lower than this previous high, so that the market will continue to be in a downtrend. But look at it here, there was what? A change in character. Now from this point here, now this high now became higher than what? The previous high. Now looking at this now, you will see that the pattern has changed. And that change in character, that is what is called the market structure shift or market change in character. Now, I want you to understand that once a change in character occurs, now the market will no longer obey the previous pattern, but the market will now continue with the new pattern that is formed. And this new pattern will now give you a higher lows, a higher high, a higher low, and higher high. Now before you know, there is a transition from the downward movement to an upward movement. Okay, now I want you to understand the market structure shift gives you a reversal pattern, and the break of structure gives you a continuous pattern. So when you are dealing with smart money concept, you are to mark that point where the previous structure was broken. Is very important. Okay, so this is the place where the previous structure was broken, and after that, the next thing you should be expecting is a reversal in the price. I believe that you have learned something from this video. In my next video, I'll be showing you how to make the best entry decision using the smart money concept. But before you go, don't forget to hit the subscription button, like this video, share the video so that it will benefit others also. I would like you to turn on the notification button so that when I post the video, you will be notified. Have a successful trading week ahead. Bye.